We're going to calculate the stock price for Nike. And first we need the market cap, which is 154.5 billion. And we'll put that into the spreadsheet. And then the stock price, 99.38. Now to calculate the intrinsic value of a stock, we have to estimate the future free cash flows of the company, discount that number back to today's values, and then we have the value of the company. Now we have to divide that number by 1.5 billion shares, and then we get the intrinsic stock price. And we're going to compare it to the actual stock price to see if it's higher or lower. Now we need to get the actual free cash flows to put into the model. We'll go to the financial section in Yahoo, go to cash flow, and then we'll take these 4 years of free cash flows. For some reason Yahoo only lists 3 years of financials, so I'll just use a trailing 12 months number. Let's get the net income from the income statement. And this is the profit and loss for a year. Then the revenue. Okay, and the numbers look pretty good. Nothing stands out too much. Now we need to look at the capital structure of Nike and figure out the discount rate we need to apply to future cash flows. So there's no interest expense in Yahoo. So we have to go to the 10K. Let's find the income statement in the 10K. Let's just search the term interest expense. $49 million. Looks like it's 49 million. Now we need to figure out how much debt they have. We'll go to the balance sheet. It's a lot easier in Yahoo to find this stuff than to search through the 10K. Current debt of 15 million and long-term debt of 3.5 billion. And long-term is due after 1 year. So they only pay 1.4% interest on their debt. Interest payments are tax deductible, so let's get their effective tax rate. And that's in the income statement. 16% taxes they pay. So the cost of debt is only 1.18%, and they only have 2% of debt in the capital structure, which is really good. Now we need to look at the beta because we want to find out their cost of equity. 0.76. That's a really good beta. It's very low volatility because a beta of 1 means the price of the stock moves with the market. When it's under 1, it moves less than the market. So it doesn't have as many big jumps up and down, which is actually a good thing. So the cost of equity is 8%, and cost of debt is 1%. So equity has a higher return than debt because equity is riskier. In the event of a default, debt holders are paid before equity holders. So debt holders take on less risk, they get less reward. Equity holders take on more risk, they get more reward. Now to get the WACC, you have to combine these two numbers. The weighted average cost of capital is exactly 8%, and that's what we're going to discount the future free cash flows by. So we estimated the free cash flows for 4 years. Then we did a terminal value, which is all the years beyond year 4. And we used a Gordon growth model for that. And then we discounted these numbers back to today's dollar amounts. And the value of the company is $94 billion. And when you divide that by 1.5 billion shares, you get a stock price of $61. That's what we call the intrinsic value of the stock price, $61. It's trading at 99, so it's a sell. It's trading at a 64% discount. And with this is historically the stock price of the company, and let's see if it was maybe 2.5 years ago, it was trading around 60, and apparently the price gets bid up when more people want to buy the stock. So in this case, the price got pushed higher than intrinsic value. So I see this a lot with more well-known companies, is people perceive them as better than they really are. And I'm not saying Nike is not. I'm just saying it's kind of like when you go to the store, you might be willing to pay $100 for a Nike pair of shoes than $80 for a no-name brand, even if the shoes were exactly the same. They came from the same factory, but the no-name brand, you just don't know who they are, so you just buy Nike. Kind of like that with investing. People just feel more comfortable. And sometimes they're right, because other people also feel more comfortable, so the price gets pushed higher and higher. And in Nike's case, I think that's fine, because I don't think they're going anywhere. But for some other companies, when people keep buying their stock, even though they're reporting losses, it's going to be a problem when they file bankruptcy, because then you're going to lose all your money. So everybody has their own opinion on stocks. This is just my model and my opinion. So thanks for watching.